Hey guys, welcome back to Andrew Invests. On this channel, we like to talk about stocks because stocks make the difference between being rich and being wealthy. Specifically today, I want to talk about Amazon stock. The company had Prime Day earlier in the week, which saw record revenues and record sales. But I actually chose this time to sell out of my Amazon stock. Why would I do that? After all, the company is a household name, but household names don't necessarily mean that a company is a great investment. So today I want to speak about increasing competition, poor leadership, and why I don't think the company is as great an investment as may seem on the surface. To start with, we need to understand Amazon's controversial business model. Amazon does not behave like a traditional company. If we contrast it with Apple, for example, Apple tries to maximize its profit margins and returns capital to its shareholders via buybacks and dividends. But Amazon actually tries to artificially lower its profit margins, which are low anyway, in order to reinvest it back into the business, not have to pay taxes, and it also doesn't pay shareholders any capital. This allows Amazon to take market share from its competitors who have to have higher margins, and it also allows it to expand into other industries which may need disruption. This has paid off for Amazon in the past with its bet on AWS, which is now the most profitable part of the business. But what does it mean for shareholders? After all, the main reason that shareholders own shares in companies is so that they can get a share of the company's cash flows and cash going forwards in the future. But Amazon's entire business model relies on it not having to pay any money back to shareholders at all. Now, the idea is that eventually Amazon will reach a point where it's mature enough to pay back investors. But let's say, hypothetically, Amazon literally couldn't pay back investors because of either legal or, in this hypothetical scenario, it just can't. That would mean that Amazon as a company is literally valueless. It would be just pure speculation betting on whether the stock goes up or down because there's no actual value being provided to an investor in the present or the future. Now, I'm not saying that Amazon physically will never pay a dividend or do significant buybacks, but I do think that it's really difficult for the company to do so. After all, its business model relies on the fact that it doesn't make any profits, doesn't have to pay any tax, and can outcompete its rivals in that fashion. But when you look at the company and take away all of its growth into these new sectors, what are we left with? We're left with a very low margin online e-commerce business, and we're left with AWS, which is highly profitable but is slowing down in its growth because of competition from the likes of Microsoft and Google Cloud.
Documents filed by antitrust regulators in a U.S. court this week showed that Azure generated $34 billion in revenue in the 12 months that ended June 2022. During that same period, AWS saw $72 billion in revenue.
Now, don't get me wrong, AWS is a fantastic business. It's hugely profitable, and it pretty much funds all the parts of Amazon's business that don't make any money. If it was spun off into its own individual company, I would be buying it in a heartbeat, depending on the valuation, of course. But a company usually doesn't strike gold twice, and if it strikes gold first, it needs to deal with increasing competition from its competitors. Has Amazon cemented a hold on the cloud business in the same way that Apple has cemented its hold on the smartphone business? In my opinion, no, but let's get into that later. Now, what else has Amazon been investing money into in order to find the next AWS? Doorbells, automatic hoovers, streaming music, streaming video, and grocery stores. Are those the kind of businesses that I want to be investing my money in? Probably not. And Terry Smith, the legendary investor, agreed with me and he sold Amazon, although a while back. He's been receiving a lot of flack, especially this year after Amazon's monster rally, including from one of my favorite YouTubers, Joseph Carlson.
I want to comment on a few things here. Obviously, there's the indication it was a mistake because Amazon is up 51% year to date. He also mentions that the CEO of the company is relatively new. And that's true, he is a relatively new CEO, but he leaves out that Andy Jassy has been with the company for over 20 years. Andy Jassy was the one running AWS. And it is true that Amazon has stubbed its toe in grocery retail. That's a phrase that he uses there. But this phrase could be applied to the entire history of Amazon. When has Amazon not stubbed their toe doing something?
So Joseph raises some interesting points there. What I would say in response is that there are loads of companies this year that have had their stock prices completely explode without that much change in their business's fundamentals. Just look at Arc Innovation. Is Cathie Woods a genius now because the stock price is up by 60%? No, Joseph Carlson would definitely not say that. So I think that it's not necessarily a valid point to use Amazon's spike in stock price as a reason for Terry Smith being wrong. He may have just been wrong on the timing. Carlson also points out that Amazon and investors have had to get used to this behavior for a long time because it's just part of Amazon's business model, i.e. that Amazon will place bets on outlandish ideas. Some of them will be successful and some of them will flop. But I would say in this instance is a little bit different because Amazon already bet on groceries and it failed, and yet they're doubling down. That kind of tells me that they're running out of ideas in how to invest their excess cash. After all, the industry of groceries has been pretty low margin and awful for years now, and Amazon has already showed that they haven't been able to change that. Last of all, I want to point out that despite Andrew Jassy being head of AWS for a long time, I personally think that he's one of the worst big tech CEOs out there. He was actually dodging earnings calls for nearly 2 years after he started as CEO, and that's just not the kind of behavior that makes me think as an investor that I should have confidence in him. I also want to point out this interview in which he talks about competition from Temu and other Chinese rivals.
That there's this sort of rule, loophole perhaps, that if you're shipping something directly from China worth less than $800 into the US, you don't pay tax. And that's part of what's helping these companies. Is that something that you think needs to change?
About applying a tariff to products coming in from China is, what are you actually accomplishing and who might you hurt? You know, I think about it, you know, I see it in lots of marketplaces, including our own, where you've got Chinese sellers who are always manufacturing the products. They used to sell to American or European retailers. They'd sell it wholesale, and then they would repackage it and charge more to consumers here in the U.S., where Chinese sellers have direct access to consumers, they're selling direct to consumers and at a lower price for consumers.
So in case you hadn't heard of Temu, it's one of the most downloaded apps this year, and it basically offers a marketplace similar to Wish.com, which allows US consumers to get Chinese wholesale prices on goods, which obviously means the prices are far, far cheaper than what you can get on other sites. Now, Amazon is also selling lots of Chinese goods directly from consumers, so it means that it can't rely on this regulation in order to drive the threat of Temu, Wish.com, Shein away. Now, Temu's delivery times are far longer than Amazon, and that's the one competitive advantage it has over these sites. But what I would say about Temu and Chinese rivals is that it shows that the e-commerce business will be probably low margin forever. There's just so much competition, and it's impossible to lower your prices so much that all the competition goes out of business. In fact, Temu, Shein, and all of these others are now using Amazon's tactic against it by lowering their prices to ridiculously low levels so that Amazon can't compete. I want to talk about AWS briefly. I previously said that part of the business is probably the best part of the business, but recently growth has been slowing as different cloud platforms have started to catch up. Amazon was the first, and it had plenty of time to build up a moat in the industry, but I personally don't believe that it offers that much value for money when you compare it to other platforms such as Azure. As a software developer myself, having used C# and other Microsoft tools like Visual Studio and various other things, Azure is so much easier to use and integrate with these Microsoft solutions than AWS. and I really believe that they will overtake them in the future. Not to say it will be a sudden collapse, but I would worry about the potential for AWS to drive all profits at Amazon for, the next few decades. Let's take a quick look at the fundamentals of the company. We can see that Amazon has been growing its revenue at a sky-high rate for the last decade or so, and also looks like the free cash flow is growing at a healthy rate other than the last 2 years, which let's just take it as an exception until we actually look into the graph a little bit further. We can see that stock-based compensation has been growing at probably a faster rate than the free cash flow. Even if free cash flow was to recover to 2020 levels this year, it probably would only just about break above the stock-based compensation. That's not particularly healthy, and the company can't seem to keep its costs down, even with the heavily profitable AWS. The capital ratios, the return on capital employed for the company, are pretty mid-tier, to be honest, as well. Looking at the shares outstanding, we can also see that even though the company is $1.3 trillion worth of market cap, the shareholders are still being diluted year on year. So in conclusion, I would say that Amazon still has potential to be a really great company, but its business model is so unorthodox and different to the traditional model of why you would buy a company that I don't think it is worth the risk. I'm not prepared to take the risk with my money when there are much better opportunities out there, in my opinion. Companies that provide really high return on capital employed, really high profit margins, and return money to the shareholder. So that's why I sold out of Amazon. Even though it was a relatively small position, I probably won't be reinvesting in them, and I actually reinvested the money into Ulta Beauty. And I will probably be buying more Visa stocks soon, although it is kind of disappointing that I have to raise my cost average of my share price that I bought in at up when I buy more shares. But that's it from me today. I hope you did enjoy this video. I know it's a bit of a controversial one, but let me know what you think. I'm always happy to hear your opinions, so I'll see you guys next time. Please like and subscribe if you did enjoy the video.